So hello everyone, in this video we're going to learn what is a bull call spread, how do you apply it, and what kind of market should you apply it, and what is the whole logic and reasoning behind it. So just in the name, a bull call spread. So it's a spread that includes just call options. It is a bullish strategy that you apply in the market when you're bullish on any stock or any index, and the strategy works by usage of two calls. So you buy one at the money call and then you sell an OTM call. Now, in case you don't understand what at the money is or out of the money is, I have a playlist in my YouTube channel that is on options. So go watch that in case you don't know it. It's the part one where I've talked about moneyness of an option. So here I have a if I were to execute a bull call ladder today, this is what it would be. Let's just do it again. I just wanted to show you the graph first. But anyway, let's do it again. So what did I tell you? You buy an at the money call option. Where is the Nifty spot price right now? That's 16,245. So to buy an at the money, it'll be 16,200. So you add that first, and then you sell an out of the money call option. So what is an out of the money? Out of the money is even 16,300, but we'll choose 16,500. So now I've added the positions. And this graph that you see, right? This is on the day of expiry. The expiry that we have taken is 31st March. So we have bought a 16,200C for 497, and we have sold a 16,500C for 347. Now look over the max profit here. It's around 7,500, and the max loss is also around 7,500. So your risk to reward is 1:1. Your break even is 16,350. So for you to not have a loss on expiry on 31st March, the market needs to close at 16,350. That's where you'll not have a loss. Above that, you'll be in profits. Below that, you'll be in loss. And this is just telling you how much margin will be required to execute this trade. So now let's look at the graph here. So on the x-axis, you're seeing different prices in the spot. So what is this telling you? That on 31st March, depending on where the spot is, that is where your position is going to be. So let's say on 31st March, the market closes at 17,000. So if it closes at 70,000, can you see 17,000 here? Yeah. Our PNL will be 7,500. Let's say the market closes at say 16,000. So what happens at 16,000? We have a loss of 7,498. Did you observe over here that beyond this point, that is 16,188, and beyond this point, which is 16,500, the profit and loss are constant. So this is where the whole game is, right? Beyond this, you're gone. Above this, you just have the same profit regardless of how much the market goes up. And that's because you're in a way hedging both your positions, because one you're buying a call option and other you're selling a call option. That's why you have this flat line that is showing before you. So when do you apply this strategy? When you're bullish on any stock or any index, and this is the payoff graph that you're going to get. Now I want to add the money call option, right? Spot was at 16,200. We bought a 16,200 call option. Let's say that you want to be a little more aggressive on the bull call spread. So what you do is you go deeper in the money. So instead of 16,200, I might buy 16,100. So I am in the money, but I'm a little more in the money than I was before. And then you see what the profit becomes. It goes to 9,350. Before it was 7,500, and now it is 9,350. But so as your stop loss increases, sorry, your max loss is also increased to 10,650. But my point being that the more bullish you are, the more in the money you can go. All right. So that is how the profit increases. Now, in case you're confused about why does the profit increase and you're going more in the money, you'll have to watch the second video that I've made. That is the option Greeks videos. And in that, there's a variable called delta. And because the more in the money we go, the more the delta increases. So let's assume that 16,200 call option had a delta of 0.5. So 16,100 call option will have a delta of 0.6 or something. So basically, the more in the money. Well, let's say if you go 16,000, its delta will be more than 16,100. So the more the market will move up, the more the our call options premium is going to rise. And that is how we can be aggressive over here. The more in the money we go, the more aggressive we are. It's a very simple strategy. It's one of the most basic strategies. So that's it for the video. You know the drill. Like, share, subscribe, and Don't forget to hit the bell icon to keep yourself updated about the next videos, and see you in the next video.